Ripple's strategic power play. The Circle acquisition that could still happen. Ripple just dropped a bombshell announcement that has the entire crypto industry talking. They're officially in full-on acquisition mode, aggressively hunting for critical infrastructure in the cryptocurrency space. But here's where things get truly interesting. A viral report just revealed that Ripple attempted to purchase Circle, the powerhouse behind USDC, the world's most trusted stablecoin. While Circle turned down the initial offer, there's a looming market shift that could force them back to the negotiation table, and possibly at an even lower price. The chess game between these crypto giants reveals a high-stakes battle for control over the future of digital payments. And if you think the Circle deal is shocking, wait until you hear about the company I believe Ripple is targeting next, a move that could completely reshape cryptocurrency liquidity overnight. The most fascinating part? Circle's rejection of Ripple's offer might ultimately prove to be their biggest mistake. A perfect storm of economic factors is approaching that could dramatically slash Circle's valuation, creating the perfect opportunity for Ripple to strike again. By the end of this analysis, you'll understand exactly how Ripple could still acquire Circle at a bargain price, and the alternative acquisition target that might be even more valuable. Why Ripple desperately wants Circle. Circle currently dominates the compliant stablecoin market with USDC, boasting nearly $65 billion in circulation. While Tether may have larger numbers, Circle has positioned itself as the regulation-friendly option with stronger US presence. Ripple's competing stablecoin, Relust, is still in its infancy, facing an uphill battle to catch up to Circle's massive head start. That Ripple's strategy became crystal clear. Instead of competing with Circle's established USDC ecosystem, why not simply acquire the company and convert all that USDC into Relust? Brilliant in theory, but Circle wasn't biting at Ripple's reported $5 to $6 billion offer. From Circle's perspective, with $65 billion in stablecoins already circulating and generating substantial revenue, that price tag seemed far too low. The rejection highlights a fundamental difference in vision between these companies. Circle has built its empire on a retail-focused, bottom-up approach where everyone, from individuals to institutions, relies on their USDC stablecoin. Ripple, however, is pursuing a fundamentally different strategy, positioning itself as an enabler rather than a provider. The clash of stablecoin philosophies. Ripple's approach is telling financial institutions, why trust a third party like Circle when we can help you issue your own stablecoin? They're offering banks the infrastructure to create customized stablecoins while connecting them to the XRP ledger for deep liquidity. It's a compelling pitch for banks wary of depending on fintech startups. When you break it down, what bank CEO would want to put all their eggs in Circle's basket? Most would prefer Ripple's model, creating their own stablecoin without the counterparty risk of relying on an external provider. This fundamental difference in strategy explains why Ripple wants to acquire Circle rather than compete directly. They need Circle's established DeFi footprint. Circle has already deeply integrated USDC into the DeFi ecosystem. Lending protocols, decentralized exchanges, and various blockchain networks all have extensive USDC liquidity. This existing infrastructure integration gives Circle a massive advantage that Ripple's Relust simply can't match quickly. While traditional financial institutions haven't widely adopted stablecoins yet, that market remains open. But in the decentralized world, Circle's USDC has already established dominance that would take years to challenge. Circle's hidden vulnerability. Here's where the story takes a fascinating turn. Circle's impressive $1.6 billion annual revenue stream looks impressive on paper, but examining the details reveals a critical vulnerability that Ripple seems to have identified. First, of that $1.6 billion revenue, Circle pays approximately $1 billion to Coinbase, leaving them with around $600 million. But even more concerning is how Circle generates that revenue in the first place. Their business model is straightforward. Users deposit dollars. Circle issues USDC tokens, and then invest those dollars in treasuries currently yielding around 4.5%. With $65 billion under management, that 4.5% yield creates their substantial revenue. But this model contains a ticking time bomb. The current high-yield environment is an anomaly, not the norm. For most of the past decade, interest rates hovered near zero, often around 0.25% to 0.5%. Circle is rushing to go public at a $5 to $6 billion valuation based on revenue that's entirely dependent on these unusually high interest rates. The perfect storm approaching Circle. all economic indicators point to interest rates dropping significantly in the near future. Unemployment is rising, job numbers are falling, and inflation has already approached the Federal Reserve's target, with government reports showing 2.4% and private surveys indicating just 1.3%. The very reason for high interest rates, taming inflation from its 9% peak, has already been accomplished. Additionally, the incoming administration has made no secret of wanting lower interest rates. This political pressure, combined with economic indicators, virtually guarantees rates will fall precipitously. When, not if, rates drop from 4.5% back to historical norms of 0.5% or lower, Circle's revenue won't just dip, it could potentially collapse by 80–90%. Imagine Circle's $1.6 billion revenue plummeting to $100 to $200 million overnight. While still significant, this dramatic reduction would decimate their valuation, especially as a public company where every financial detail is transparent to investors and potential acquirers. Ripple's brilliant waiting game. This vulnerability reveals Ripple's potential strategy: patience. If Circle rushes to IPO at their desired $5–6 billion valuation and interest rates subsequently fall as predicted, their stock price would likely plummet. At that point, Ripple could swoop in and acquire Circle on the open market at perhaps half their current asking price, potentially just $2 to $3 billion. Even a moderate interest rate reduction to 2% would slash Circle's revenue by half, making them a far more accessible acquisition target. By acquiring Circle under these conditions, Ripple would gain control over both traditional market infrastructure and the decentralized dollar-denominated market, cementing their position as the dominant force in cryptocurrency payments. Ripple's alternative target: controlling global liquidity. But what if the Circle acquisition never materializes? Ripple appears to have a backup plan that might be even more strategic. My analysis suggests Ripple could target a major cryptocurrency market maker like DW Cumberland. Market makers are the unseen engines powering cryptocurrency liquidity, and acquiring one would transform Ripple overnight. The XRP ledger aims to become the deepest liquidity pool in crypto, serving as an automated clearinghouse for the entire industry. Currently, this function is performed manually by market makers. If Ripple acquired a leading market maker and directed that liquidity through the XRP ledger DX, they could position themselves as the global clearinghouse for the entire cryptocurrency ecosystem. This would complement their existing strengths in centralized forex transactions and prime brokerage through Hidden Road. The endgame: Ripple's global domination strategy. While acquiring Circle would certainly generate more headlines due to name recognition, purchasing a major market maker might actually deliver greater strategic value. It would allow Ripple to control the most fundamental aspect of cryptocurrency markets: liquidity itself. The ideal scenario for Ripple might be acquiring both: first, a market maker to secure liquidity dominance, then circling back to acquire Circle at a discount once interest rate changes have diminished their valuation. This two-step strategy would give Ripple unprecedented control over both centralized and decentralized financial infrastructure. What's unfolding is nothing less than a chess game for control of the future financial system. Whether through acquiring Circle at a discount, buying a major market maker, or executing both moves sequentially, Ripple is positioning itself not just as a cryptocurrency company, but as the central infrastructure of a tokenized financial future. The next few years will reveal whether this ambitious strategy succeeds. But one thing is certain: Ripple's aggressive acquisition moves signal that the consolidation phase of cryptocurrency has officially begun. The companies that emerge as infrastructure owners will shape digital finance for decades to come.